And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's Tuesday. Yes, already Tuesday. Of course, Labor Day yesterday. I hope you enjoyed your day off. So it's a holiday shortened trading week to start with, which will also mean lighter trading volumes this week, but it's going to go by a lot faster. But we are kicking off the month of September, which, as on today's report, which is on the website, realinvestmentadvice.com, our Tuesday blog, is talking about the risk that investors face over the next 2 months, in particular as we head into the election. Seasonally, we are entering 2 of the seasonally weak periods of the month. Now, don't ask me why, but every major crash in history has occurred in September, October. 2008 financial crisis, 1987, just 1929. I don't know why that picks September, October to crash, but that's just what happens. But anyway, those big crashes have skewed the performance of those months over history, because they all tend to cluster right around that area. So September, October tend to be weaker trading months. Now, does that mean every year is a weak September, October? Nope, not at all. Doesn't mean that at all. It just means that historically we've had events that occur and we have weaker trading more often than not in September, October than not. But it certainly doesn't mean for a fact that absolutely guaranteed you should go hide in a bunker for the next 2 months, because that's not what that means, right? I mean, we could have a very strong September, October. Now, there are some risks, though, as we move into the 2 months coming up. that we've got to think about, right? And this is in today's blog. We kind of go through the details. First of all, investors are back to being very exuberant after this run from the the August lows. We're back to very exuberant levels. We've also got positioning is becoming very bullish here. And also, we have a couple of other things that are occurring, right? One of the big buyers of this market ever since the lows in August have been corporate buybacks, right? Share buybacks, corporate repurchases. Those start to close on the 5th because we're now getting ready, October, right around the corner. We're about to enter back into earnings season again. So as we get closer to earnings season, starting September the 5th, corporations will enter their blackout window where they can't buy their shares ahead of their earnings report. Now, once they announce earnings, they go back to buying shares, and that's why we kind of get these waves of corporate buybacks that occur over time. When was the last time that the corporate buyback window opened? Right at the lows of the market in August, because we were closed in July for reporting. So again, as we kind of go through these periods, we see these same type of events occur, and here we are entering that period of time where you've also got election risk coming up. And again, markets tend to de-risk a bit before elections only because they don't know with certainty who's going to win the election and what that means for policy, right? Policy is what matters. Higher corporate taxes, lower corporate tax rates. Two very different policies, two very big different outcomes potentially for corporate profitability. Remember, this all goes back to corporate profitability and earnings. So if I'm going to institute policies that will increase cost on businesses, that will lower corporate earnings and corporate profits, and then, well, with markets kind of priced for perfection right now, that would suggest basically a lower outcome potentially as market prices have to adjust for potentially lower profits because of policy. So markets tend to de-risk a bit ahead of uncertainty of elections, and particularly in a year like this year, where you really have two very different sets of policy outlooks. It's going to be kind of hard to hedge for that. So reduction wouldn't be surprising. So again, that's kind of what's coming up here over the next month or so. But we kind of go into depth this morning in that article on the website, kind of go through those risks. So if you go to realinvestmentadvice.com, it's a click on the Insights tab. It's today's blog on the tab, and you can certainly read into that a little bit more detail. I've got some technical charts talking about momentum, etc., in there as well. So it kind of goes through the whole setup for why we suspect there could be a bit more volatility over the next month or two. Okay, but with that said, let's talk about today. Right? Here's what you need to know before the bell this morning. Again, coming off a holiday week or holiday long weekend, we've got a short trading week this week when volumes will be a little bit lighter. But overall, the market is pushing up right in. So as of Friday, we closed right at really kind of the previous highs that we set back in July. Now, we talked about this previously. We said that once we cleared all these kind of moving averages coming off that yen carry trade blow up in August, that a challenge of all-time highs would be likely, and that's where we are. So now if markets can break out to all-time highs in the next day or two, that's going to be good. That'll be a breakout. That'll certainly continue to allow for momentum to carry the markets higher, and that's what you've got going on right now. You got a lot of bullish optimism happening. And again, we're back into kind of extreme greed territory in terms of our sentiment positioning indicators. You take a look at the number of stocks, the breadth of the market, that's been improving as a rising tide lifts all boats. We're getting more and more stocks kind of getting drug up with the overall advance. That's good, by the way. Better breadth is good for the markets. But we're going to challenge this kind of key resistance here today. Now, markets are set to open a little bit lower this morning. So if the markets do close down today, again, we're still within this kind of consolidation range that we've been in now really for about the last 2 weeks. Markets really haven't gone much of anywhere. So again, if we open down today, stay down all day, that's just going to keep us right within this consolidation range. Now, for the markets, what's going to be happening here over the next day or two, really towards the end of the week, if we start getting further declines in the markets, and we break to the downside of this kind of consolidation range, then potentially we're going to start retesting the 50 and the 20-day as support. Now that 20-day is sitting right at the 50 now, getting ready to cross above that. That's bullish. That provides support for the markets. But we have some real near-term support if the market does break down. Again, if we break out to the upside, then we'll have a breakout to all-time highs. But with markets overbought and extended, really, it's going to be difficult, even with the breakout, to have substantially higher highs, at least in the near term. Now, we can kind of continue to grind higher here, but today's action will be really important because, again, if markets kind of fail at this all-time highs, this will be the first test of that resistance, a failed test of that resistance. If the market continues to struggle, then the risk of a decline becomes a little bit higher here over the course of the next couple of weeks. So again, just kind of keep a watch on that. We are seeing a loss of momentum though in the overall markets, and again, as I said, markets are overbought here. So again, it certainly doesn't hurt to take a little bit of profit here, just kind of rebalance risk. Certainly don't become overly negative at this point. Again, the bullish bias behind the market, breadth is increasing. Markets want to move higher here, but we do have some risk, as I said, over the next month or two that could certainly increase some volatility here in the short term and make things make trading a little bit more difficult. So again, just kind of monitor the risk in your portfolio accordingly and adjust for that as needed. And again, as we talked about last week, bonds remain very, very overbought here. Now, I would suspect that we're going to get some data out over the next month or so that leads to yields ticking back up. Now, this is a chart of the 10-year Treasury yield. Yields are very, very overbought now, and so and are very oversold now. So again, we need a bit of a rally in yields to get a better entry point into bonds, which are very overbought. So again, I would expect kind of a move up back towards 4.1% on the 10-year Treasury. That 4.1, 4.2, somewhere in there likely will be the next best opportunity to add to bond exposure on the longer duration side. But again, it's really kind of too late to do it right now because they're so overbought. So look for a reversal there to add bonds to your portfolio. Okay, that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. We're going to talk a little bit about why past performance is so important to pay attention to and why you need to understand what that really means. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of things that John and I want to get into this morning. And one's kind of a really important topic. And I've talked about this in the past a bit, but I don't think that, we've discussed it enough. And one of the interesting issues is when people are looking for an investment, right? And especially if it's an ETF or it's a mutual fund, etc., they start going to things like Morningstar, which Morningstar is a very revered source of financial research, but ratings, etc., that they produce are not good, and you shouldn't use them. And remember, Morningstar is designed to sell you a product. So you want to be careful, as always, worrying about the biases of what you're doing. But again, as far as a research platform, Morningstar is very good, but you have to understand, like with any research platform, you got to understand how to use it. And the problem is that most people don't understand things when they're making an investment. And so I'll give you a good example, bond ratings. So I get too many people that say, well, I bought this bond in my portfolio because it was AA rated or AAA rated or A rated. And so I was like, okay, well, that's fine, but tell me about the bond, right? Well, it's A rated. Okay, well, that's great. It's A rated. But tell me about the bond. What's the company, or, tell me what's behind the bond. And they can't, right? They don't have any understanding about what's behind there. They just bought it because it's A rated, right? So it must be good because a rating agency rated it A. I'll tell you a few stories. On Friday, September the 18th, Lehman Brothers was rated AA by the rating agencies. On Saturday, it was bankrupt. And this is the same thing with AAA rated mortgage-backed securities in 2008 and a whole variety of other things. But this isn't just recent 2008. This is all through history. Let me ask you a question. And if you're in our chat right now, you can throw your answer into chat. I'll give you a pause. I'll pause for a moment and allow you to answer in chat. Who pays, or let me rephrase the question. How do rating agencies make their money? Who pays for that? Who pays for that rating, right? Is it you? Do you pay a fee to the SEC to fund the rating agencies so that you have accurate and reportable ratings on your bonds? Or are the companies that are issuing the bonds paying the rating agencies for the rating? And this is why, and if you know the answer to that, it's the companies that want to issue the debt. They pay the fee. And this is why that you never see downgrades really on ratings until after the fact, to where there are any of you real used to. So understanding where ratings come from is incredibly important. Now we'll talk about the subject. So understanding that, this also applies to stocks. But let's talk a little bit why every performance report that you ever see, John, every performance report, what is the disclaimer at the bottom of the performance report?
Past performance is no guarantee of future results. I may make up some bumper stickers or maybe some T-shirts, ball caps,
that's what I tell
coffee mugs.
Yeah, I don't know. All I do is I just tell you, that's just what I tell my wife every week. So,
sorry, this is what it was all in the past, honey. It was all in the past. We got to look forward.
Exactly. But, this is the big mistake that investors make, John, is that, they look at this past performance. And this is where Morningstar is a terrible resource. Because you look at a mutual fund or some manager, whatever it is, and it's like, okay, well, here's the returns over the last 1, 3, 5, and 10 years relative to the S&P. And so you look up this fund, and it's like, great, man, this fund has beat the index over the last 10 years. What happened in year 9? Or year 8, or year 7, or year 6, or year 4, or year 2. What happened in those? And see, this is the problem with investments in general, is that what you have to look at as an investor is how did that fund perform when there were similar conditions to where you are today? Valuations, economic environments, those type of things. Now, that doesn't mean that those ratings are wrong, because if you bought it 3 years ago, then that is going to be your performance over that 3-year period. If you bought the fund 10 years ago, that's the performance you had. If you bought it anywhere in between that, your performance is different. And if you happen to buy the Bill Miller Legg Mason fund at the peak of 2007 because he had beat the market for 15 years running, you didn't do so well. As they always say, John, timing is everything, right?
Well, it is, excuse me. And, it's easy. I think as investors, it's very easy for all of us to really kind of focus on the data. Well, let's look at the past to try to kind of figure out what's going to happen in the future. I don't know about y'all. When I drove into the office this morning, I really wasn't looking in the rearview mirror. I was looking forward through the windshield as far as what's next.
Right.
What do I need to navigate from here? Right. Because what's in the past is in the past. And I think something that I see on a regular basis, Lance, is when individuals are maybe looking to, start a relationship with a financial advisory firm. All of a sudden, because they've been kind of trained, and by sites out there like Morningstar, and there's several different sites out there. And Morningstar, yeah, I agree with you. The rating system there, I probably wouldn't put a whole lot of weight into that. But if there's something that you own, if you own a mutual fund, or if there's a certain exchange traded fund that you own, it's great for that, because you can go in there and you can dive in and you can look at what the internal holdings are, just get an idea about what is the makeup of that particular investment, right? It's really good for that.
As a research tool, it is very good.
But as far as the ratings go, I agree. I wouldn't give that a lot of salt. But I think I find that a lot of folks will kind of treat financial advisory firms in the very same way, where they'll say, well, I'm looking at 4 or 5 different firms, and hey, I'm going to see the past performance on each one,
sure.
And based off that, I'm going to pick who I think makes sense to work with moving forward, right?
Makes complete sense.
Right?
Makes complete sense.
Well, those numbers only go so far. Again, it's all in the past. It's not forward looking, and who knows what type of market environment we're going to get into. So rather, so there's another P word, or word that starts with the letter P, that I think is a better way to look at, selecting an advisory firm to work with. It's not so much the past performance. I think it's more around what is the philosophy of that firm, and is there a match for what you're looking for and what that firm provides? Because in any given year, any one financial advisory firm will outperform or underperform the other.
That's right.
And if you kind of start treating your financial advisory firm as like a mutual fund or an exchange traded fund, all of a sudden you're bouncing around from one investment to the next. And you're not really, in my mind, you're really not building a relationship at all.
Well, and the other side of this, though, is you're starting to just jump from the frying pan into the fire. And again, we had a good question in chat as well about this, saying, well, if not for past performance, what do we evaluate a fund by? Great question.
Sure.
That's exactly the question you want to ask. Because, again, you have to look, performance is important. I'm not saying that performance isn't important. You shouldn't just ignore performance, but you don't look at 1, 3, 5, and 10-year performance. You look at year-by-year performance relative to the market environment, the economic environment, et cetera. Here's a good study about this. Every year, S&P puts out a study of managers relative to their benchmarks, and it's called the SPIVA study. And it says, well, this year, 70% of large cap fund managers didn't beat their index this year. Okay, what does that tell you? Or 50% or 80%, whatever the number is, right? But only 10% of managers beat their index this year. Well, great. I want to own that manager, right? I'm going to go find the 10 that beat the index this year. I want to buy that manager because he's obviously very good. You got to be really careful about that. Because, you go back in history, and some of the greatest fund managers in history, whether it was Sequoia Fund or Peter Lynch of Fidelity Magellan Fund, these are great investors. Did they beat their benchmark every single year? No. But they crushed their index over 20 years. And they survived big market downturns. They survived the crashes. They managed well when markets were up. Did they beat the index every year that the index was up? No, that's not what you're looking for. What you're looking for is survivability over time. And so you want to make sure and evaluate not whether the fund is beating an index. That's the least important thing out there, because here's a good example to John's point, right? You're going around, you're shopping for an advisor right now, and you go, okay, I got 5 advisors. This guy killed it last year. They just crushed the index last year, so I'm going to go with him because his performance was the best. Well, you got to really understand, well, what did you just buy into? Because if last year, I get a good example. I ran into an advisor. He was killing it. This was a few years back. He was killing it. Beating the index every year for like 5 years. He had one holding in his portfolio. One. All of his clients were 100% invested in Google.
Wow.
Now, that works great until it doesn't. So we'll come back. We'll talk. There's a lot to unbox in all this. So we'll come back and talk some more of that with Jump In. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife has this KitchenAid mixer. I bought it for like 15 years ago. And this is before, I guess, the invention of lighter materials. I'm not sure. Brent's nodding his head. This thing probably weighs a good close to 100 pounds.
It's a boat anchor.
It's actually shaped like a boat anchor.
The Real Investment Show podcast.
If you ever lose a boat anchor, just throw a KitchenAid back there. It also works as a propulsion system.
At realinvestmentadvice.com.
I'm not banging on KitchenAid. They're awesome.
It'll run forever.
And they run forever. Need to get rid of the body. Just
tie a KitchenAid to it.
Tie a KitchenAid to it.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, past performance, no guarantee of future results. It's such a great line, right? And it's so ignored by people in general. But you shouldn't ignore it. Because, again, when you're looking at whether you're going to buy a mutual fund or an ETF or find a financial advisor, whatever it is, right? Wherever you're starting to use performance as some measure, it's really the least important measure that you're looking for, right? Now, again, please understand, I'm not saying ignore performance, right? Because performance will tell you a lot. But it's how you evaluate performance. And again, that performance has to be related to something of importance, right? So how was the economy at that time? How did that fund do during 2001, 2, 3, 4, 5, 6, 7, right? So looking at good economic years and bad economic years, how did that fund perform? Also understand what's driving that performance. There was a fund back in 1999, 2000, 2001. It was just killing it, right? It was run by Berkowitz. And he was just doing a great job. He was doing fantastic. This fund was it was all over the media. It was, when you got, Inc. magazine or Money magazine, whatever it was, it was like a top 10 funds you should buy this year. It was always like right at the top of the list. You should buy this fund. But he was heavily levered into banks. I'll tell you what happened in 2008. Right? So you have to understand, again, why am I buying this fund? And what is its purpose within my portfolio? And how has this manager navigated good years and bad years? Don't worry about whether he beat the market every year. That's not really important because again, making up losses isn't the same thing as making money. If I'm making money, it doesn't matter whether I beat some random benchmark index, right? The S&P really has nothing to do with you. It pays no taxes. It has no cash. It has, no liabilities, no withdrawal rates. It doesn't have anything, right? It's just it's a phantom index of just stock prices. And it benefits from a lot of stuff you don't, like substitution, right? GM goes bankrupt. It comes out of the index. They stick a new stock in, the index automatically rebalances for the market cap with that new company. But your portfolio, if you own the index, right? GM was $1,000 in your portfolio. Now it's $2,000. So when you take it out of the index, you can't buy $1,000 worth of the new stock, right? Without putting more capital in. So your performance will be vastly different than the index simply from substitutions. And so these are all the things that you have to consider when looking at your portfolio. And again, that's, why do we have all these things? Why does Wall Street create more and more benchmarks for you to compare to? Why do we come up with more and more things that you have to compare to, right? Oh, you got to look at performance. You got to look at this. You compare to this. Comparison is the root of unhappiness, right? Think about, Facebook and LinkedIn and all this other stuff, right? What do? We get on Facebook and look at all these other people that are driving Ferraris and Bugattis and living in, $5 million mansions, and I'm down depressed because I'm comparing myself to them, right? So, comparison, Wall Street drives you to compare because they want you to move your money, right? How was your fund doing last year? The market was up 10, your fund was up 9. Well, your manager underperformed. You need to move your money. Why do I need to move my money? Because it creates fees for Wall Street. Money in motion creates fees and income and revenue and those type of things. So again, if I get you to compare, to things that don't really matter to you and don't matter to your financial goals, then you move money, which creates fees, right? This is why if you go, and look, I'm gonna bash on financial advisors for a second. John.
Come on.
But this is why whenever, it doesn't matter how good your portfolio is. You could have the perfectly allocated portfolio and you bring it to me. I will find things wrong with it. Why? Because I want you to move your money to our firm so we can bill you, and that's how we make money, right? Look, transparency, it's very important. How do we make money? We make money by doing our job and charging you a fee. Hopefully we do our job very well. John is one of the best advisors I've ever worked with ever, and I've worked with a lot of them, right? But he's got to make a living. I have to make a living. The business I can't pay Brent to be here at crack 4:30 in the morning to do this radio show to entertain you without charging fees. So you have to understand is that whenever you go to window shop or whatever it is, there's always going to be something wrong with your portfolio, even though there's nothing really wrong with it. In most cases. But you just need to be aware of that. That's the industry. It's not just us. It's the entire industry. This is how the industry is built, and that our job is to provide a quality service for you. But again, if you're only looking at performance, and this is where we go back to the beginning of the story, if you're only looking at performance, that's where you're really kind of making a bigger mistake in your overall outlook, because now all you're doing is chasing performance, and you will continually be unhappy because you will continually have to compare your portfolio performance to something else that probably has nothing to do with you. And so you'll continually have to push to create bigger returns, which builds risk in your portfolio. And then eventually you get on the wrong side of that trade and really devastate your portfolio more likely than not. But you're always going to be moving. You're always going to be chasing. And again, one of the biggest factors for underperformance over time is swapping strategies.
Agree.
Because people go from, last year, small cap was killing it, so I'm going to move my portfolio into small cap. Well, that was last year. This year, bonds are going to outperform, or gold will outperform, whatever it is. And so now, next year, you'll look back at this year and say, well, I need to be in gold. Look how well gold did last year. So now you get into gold, just about time for it to have a bigger correction. Because everything corrects. Whatever's at the top of performance in 1 year typically tends to be at the bottom of the performance in the following year or two. Some years, maybe S&P can be top performer for 1 or 2 years in a row, but it will eventually underperform some other asset class. So what happens with most people is because they're comparing performance, they're jumping from what was working into that versus what is going to work going forward. As Wayne Gretzky once said, you want to skate to where the puck is going, not where it's been. So if you look at your portfolio today and you look at the markets, if you've got huge gains in things this year, you may want to consider taking profits, rebalancing risk a bit, because likely whatever's performing great this year won't perform great next year. It's just the function of how markets work.
Yeah, so something else too. So when you were talking about, maybe comparing your portfolio return to that of somebody else or to another group of investors, right? Lance and I and Brent, we could all be using, quote unquote, the same portfolio approach. But Brent starts at a different time than I do, and Lance starts at a different time than I do. So at the end of the year, all of our returns are going to be different. Or, maybe I'm in distribution mode. Maybe Brent and Lance, maybe you guys are in accumulation mode. So you're making deposits this whole time, and you're investing all that money into the portfolio, where I am in more distribution mode. I need more cash. So we're holding more cash off to the side and in the portfolio on purpose, because that cash is what is behind producing that regular paycheck that I need from the portfolio. So I'm holding more cash compared to you and Brent. Well, at the end of the year, again, our returns can be quite different, right? So you really have to, and that's why we harp on this so much. And I know I sound like a little bit of a broken record here, but you come back to that. What is the rate of return that you need to earn? What is that hurdle rate? And you were talking about the Standard & Poor's 500 index earlier. Right. The index doesn't know that you own it. None of those stocks in there know that you own them, right? The S&P, you need to use a different barometer to really check on what is the return that you really need over time for your specific situation to be successful. And, we're not saying to disregard performance, because you need your money to grow and work for you, fight inflation, keep your purchasing power, and you need the returns so that way you can go live the life that you want to live and leave that legacy to your family that you want to leave. But there's so many other components of this, Social Security planning, Medicare, tax efficient withdrawal strategies. What about estate planning? What's the right way to structure your assets to that way you can leave a legacy to your family? And really get to know your advisor so that, heaven forbid, if something happens to you, is your significant other, are they going to be well taken care of? And if you're bouncing around from one advisor to the next, you're not going to be able to establish that relationship, in my mind.
Mm-hmm. That's right. Well, and again, this is, the biggest mistake that, I see individuals make is that they focus on the performance rather than the advisor that they're hiring.
Agree.
And, this leads into, I've got 8 different advisors and you have no idea what's going on with your money, right? Nobody's focused on your overall well-being. You're just chasing performance at this point, which ultimately will lead to a very bad outcome. So we'll come back. I want to switch gears here a little bit, John, and we'll talk a little bit about, a little bit about fixed income,
sure,
but also about trying to reliably build a set income stream in a portfolio. So we'll come back and talk about that after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So got a question the other day is that can I build a portfolio that will reliably generate 5.1% over the long term? And right now, sure, easy. right? Just buy some T-bills and a few dividend stocks, 5.1%, slam dunk. Problem is the Fed's about to start cutting rates. When they cut rates, that yield's going to fall. So it's not reliable, right? This is the problem that a lot of individuals are going to run into. Let me show you a chart real quick. I want to explain something. And this also goes to past performances, not a guarantee of future results, and a lot of other things that happens in the financial advisory space. So a lot of financial advisors will show you this chart and they'll go, see, the market generates 7% a year, 8% a year over the long term, right? Go back to 1871, that diagonal line, right? That's 8% a year. But clearly what happened over that time is that there were years where the market performed better than that and a lot of years where the market performed a lot worse than that. So unless you've discovered immortality at this point, got bit by a vampire over the weekend or whatever, you didn't live long enough to get that 8% a year. And now here's the other problem that's going to face investors over the course of the next decade or so. This is a chart of returns over specific periods. So the first column is 1928 to 2021. The market did 8.48%. From 1928 to 1999, it did 9.25%. From 1972 to 2021, it did 8.13%. From 2012 to 2021, this article I wrote a couple of years ago, right? So that's why it's 21, not 24. But from 2012, so this is post-financial crisis, to 2021, 12%. From 2009, post-financial crisis, to 2021, end of the year 2021, 13.8%. 2017 to 2021, 15%. So what you'll notice is that just since the financial crisis, and particularly in more recent years, the markets have done extraordinarily better than the long-term averages. Of course, that was driven by $47 trillion worth of government spending in terms of QE and bailouts and TAMP and HARP and HAMP and all these other things that we did to bail stuff out, created this exacerbated performance over the last decade or so that is basically 50% more than the long-term average return. The question is, of course, and what you should be thinking is that's just simply not sustainable unless you're going to keep doing zero interest rates, more QE, more government spending, and all those type of things, right? So if we just return to the long-term average of 8, that's going to be disappointing for a lot of investors who have been wanting to get 10 or 11 or 12. Now I'm only getting 8. But the problem is that trying to reliably generate a set rate of return over time becomes much more difficult going forward than it was in the past. And again, there's a lot of things right now where people are like, oh, well, I don't, I can just, buy a bond right now and get good yields. Yes, you can. I had a great client of mine. He was about 85 years old. He's passed away now. But I started working with him in early 2000. He came to me and he had a portfolio that he had bought back in 1982. It was 100% 30-year treasuries. He had been generating, since 1982, he had been generating 11 to 12% a year since 1982, which is where interest rates were trading back then. Problem was all of his bonds were starting to mature. And when we started talking, he's like, what do I do? Because rates are now 5, 6. And that's just a huge cut to income, right? Because he'd been living off this income for the last 20 years. Life had been good, right?
Kind of get accustomed to 11%
Bond prices
per year.
went up. He had plenty of income. There was nothing to worry about. He was fine. But the challenge, right? And so this is going to be the challenge going forward is that, yes, I can build you a portfolio that would generate 5.1% annualized. But does that mean every single year? And the answer is no. Because you're going to get variability in prices, and you've got to own in order to generate an above average rate of return over the long term, you're going to have equities in your portfolio, and you're going to have volatility that comes with that.
So that's the point right there I was going to say. So building a portfolio to generate, let's say, a 5.1% return or to produce that paycheck, are you able to do that with keeping the principal amount, the dollars that are being used to generate that return, stable where there will be no risk of fluctuation of principal?
Today, today at the moment, yes, you could, in theory. But the real answer is no.
Yeah.
And the reason is that because if interest, so I could buy a portfolio of junk bonds, right? Or high yielding bonds, we should say. Let's use the marketing term, high yield bonds, and generate 5.1%. And yes, on paper, you will clip a coupon of 5.1% every year. But the price of that portfolio is going to be all over the place.
If it's still there. If we enter a more recessionary environment with those junk bonds.
But even if they're still there, the price of the bonds are going to move.
Yes.
Right? There's nothing stable. The only thing you get in life that is stable is cash and CDs.
Yeah. Yeah. So we look at this a lot with folks especially when folks are getting more to that distribution phase, and it's emotional because you've been an accumulator for all this time. And you're kind of climbing up the mountain, and now you're going over the peak of the mountain. You're like, man, I got to start relying on this money. I got to start getting into distribution mode. I need to start taking a withdrawal out of the assets. And so now we're having to generate that paycheck that you need by managing a portfolio of investments that have variable returns, right? So, so all of this, dividends, interest, as markets have strength in you and the team that you trim, you take profits. All of the dividends, interest, profits, that all flows back into the cash bucket or the money market within the account, right? And that's building up that cash reserve that's fueling those regular automatic paychecks that the accounts can send to you on a regular basis. So yeah, you can get your return. That return that we send to you can be a fixed dollar amount based upon what you need, but there's a portfolio of assets being managed behind that as the driver, the engine of that, but it's a portfolio of variable assets that are being managed to generate that fixed amount of return that you need to receive.
Yep.
Right?
Yep. No, and that's right. Look, and again, this goes back to past performance, no guarantee of future results, just to, bring this, full circle, which is, can you generate 5.1% a year, 6% a year, 4% a year, whatever it is? And I, and this is the other thing I hear from people. And I was like, boy, if I could just get 4% a year, 5% a year, I'd just be, or 8% a year, pick a number. I'd just be happy as a pig in slop. That's great. Until the market does 10.
Yeah.
And then you're going, well, why can't I get 10? Right? Or 11. We always want more. Again, this goes back to comparison. And this is why that term is there. Past performance is not indicative of future results, because Wall Street wants you to compare your performance to something else. Again, you said you would be completely fine. Your financial plan says you'll be completely fine at 5%. But the market did 7. Can I get more? Give me some more. Right? And so we always want more. But again, as you start taking on more risks to get more return, you increase the odds that you're going to wind up losing a lot of money because you're increasing the risk of the portfolio to get more return, right? You can drive faster in a car to get to your destination, but you run increasing risk of getting a ticket, having a wreck, et cetera, right? So we say we want one thing, but when we focus only on performance, it takes us away from the thing that we're trying to get, right? My goal is to get to my destination safely and on time. But if I start deviating from that because I want to keep up with traffic, I want to drive faster, because everybody else is driving faster. My son tells me this all the time. It's like I caught him. We have our whole family is on Life 360.
Oh, we are too.
So we know where everybody is, and the Life 360 will tell you when your kids are driving and how fast they're driving. And I get these alerts from my son that he's doing 106 coming home from college, and I call him and I'm like, slow your butt down. And he's like, why? Everybody's, I said, ain't nobody, first of all, driving 106, right?
Going with the flow of traffic,
I'm
Dad.
going with the flow of traffic. But I said, son, don't you understand that I'm not, speeding is fine, right? That's not the risk. What happens if you have a blowout in your car at 106? What happens to you, right? That's the same thing in portfolio performance, right? The more you want, the more danger you get into. So be careful with chasing performance. The whole point of today's show is performance important? Yes. Should you chase it? No. Right? Focus on what you need to generate in your portfolio to reach your goal safely and on time. Drive the speed limit and wear your seatbelt. All right, John, thank you so much.
You bet.
We'll be back tomorrow with Danny Ratliff. So have a great day. Get by the website. Be sure and like and subscribe to the channel. We appreciate you. Get by the website, realinvestmentadvice.com. Our blog post is up for today about the risks to expect over the next month. It's on the website now, realinvestmentadvice.com.